Good. I think we're ready, so we'll get going. This morning, as usual, we'll do the news, and then our guest this week is Richard Aston, who's the manager of CC Japan Income and Growth. But news first. So since the 7th of February, I picked out 3 bits of news that I thought were worth dwelling on. Strategic Equity Capital sort of came up with a kind of bid defence, if you like. Well, there was no formal bid. So to discuss about that. UK mortgages and TwentyFour income are going to merge. And I just also wanted to have a quick look at BlackRock Throgmorton's results. Strategic Equity Capital has been performing quite well recently, as you can see from this chart. The discount has been narrowing, but it's not come down to asset value as a few of the small UK small cap funds did. Which I think is unfortunate and probably not deserved. It deserves being a better rating than it is. But because it's been on a discount, it has attracted attention from various people over the years. And on the 23rd of December, Addition said it had approached Strategic Capital about the idea of a merger. And it said it had been talking to some of Strategic Capital's shareholders, and 33% of those, more or less, were on the side with that idea. At that time, and still today, Strategic Capital was actually the better performing fund. It was on a discount where the other one was on a premium, but you could have been arguing that maybe it should have been the other way around. That maybe they should have got together and the SEC manager should be running it, but we'll see. What's happened this week is that the board have come out and announced plans for what they're going to do with the trust to try and address the discount situation. And they said there's been no more discussions with Addition. So they immediately, more or less, as soon as they can organise it, there's going to be a 10% tender offer. So if there are dissenting shareholders who are really anxious to get out, then they'll be able to get out. And importantly, they'll be able to get out at NAV, just less costs. There was a tender offer planned for November, which would be about the sort of same size, which would have been at a 3% discount to NAV less costs, or formula asset value, as they call it normally, FAV. There's also going to be more share buybacks. So they've been buying back shares from time to time anyway, as and when the stock was available at a decent discount. Now they're going to buy back another 9% of today's share capital over the course of this year. And they're going to be doing that whenever the shares are trading at more than the 5% discount, and they can buy some stock. And then there's also a commitment that from June next year, half of all the profits they make on profitable sales will be returned to shareholders through share buybacks. Again, there's this only if the shares are trading more than 5% discount idea. If they're not trading more than 5% discount, then they'll use the cash and just reinvest it in the portfolio, so there'll be no cash drag. The manager, Gresham House, has offered to buy 5 million of shares by June 2023. Again, the same kind of deal. And again, half of all the management fee will be reinvested in the shares, as long as the shares are trading more than 5% discount. So what we've got is a number of things there that are trying to drive the discount down towards 5% from about 8.5% currently. The quid pro quo for that is that there won't be these annual continuation votes, which have been forced on them in recent years, which removes one level of uncertainty for the manager and lets them kind of focus on the day job. But in exchange for that, there will be a chance for anybody who wants to get out in 2025 to get out. They haven't said what the terms of that will be, and that will be decided much closer to the time. But I would imagine that'd be reasonably close to asset value, but we'll have to wait and see. Unsurprisingly, Gresham House Management are on the side of this, but they've also got shareholders with 26% of the share capital saying that this is a good idea. And Addition has basically said, well, that's it then. It's a shame we can persuade you it's a good idea, but we're now not going to proceed with this. So the discount, I say, is at 8.6% now. I think there's a very good chance, given all of this, that it's going to come into about sort of 5-6% in the very near future. I'd like to see it trading much narrower than that, as I've said. It'd be nice to see this thing re-expanding, but we'll have to wait and see. And it much depends on if they can continue this good period of performance. UK mortgages and TwentyFour income, run by the same manager. here you've got the performance stats and the sort of snapshot of the UK, it's the debt structured lending sector. So basically, these are funds that invest in debt and borrow against that debt to gear up the return. There's a whole chunk of them here. And actually, some of them have been performing quite well. The real star in that is obviously the Blackstone Loan Financing Fund, which has been quite good over a number of years. By the same contrast, some of them are struggling a bit. And there's a real contrast between the yields that they offer, which are really very chunky, and the returns that they make. So basically, you are giving away some NAV in exchange for this very high yield. And some of them, you're not actually really making money net overall at all. UK mortgages obviously invested in a portfolio of mortgages. Here's how it's been performing. So really, as you can see there, the share price just fell away as we went through 2020. It's come back since, helped for a number of reasons we'll come into in a minute. And just recently, it's gone to a premium. But this really is just in response to this news. So it's been around since 2015. I think we've talked about it on the show before. As I said before, it's got the same manager. It was trying to achieve returns of 7 to 10% a year. And obviously, it hasn't managed to do that. And if we go back to that side of a couple of here, you can see there that UK Mortgage has done 3.4% a year over 5 years, which is obviously a long way south of where it was targeting. And that's really the main reason why the discount widened, I think, is that people were just a bit disappointed with the returns. It's not been helped by the fact that interest rates got slashed so low. And that meant mortgage rates came down, and that meant the returns that it could earn were that much lower. When it was so out of favour, as we know, M&G came along and made a couple of opportunistic bids. And as it turned out, they were right to reject those. The share price is now well above those. And in trying to get all of this done, it helps that the funds advised by TwentyFour own a big chunk of UK mortgages. So I think this is what's going to help it all go through. This is what it's invested in. What you've got there is a big chunk of mortgages. So you can see here, they're done in silos, mix of buy-to-let and owner-occupied mortgages. And these are the outstanding balances here across all of those. This is not a huge fund, so you kind of think, well, how's it managing to afford all of those? You see there's the whole stats here on the mortgage size and all that sort of stuff. Basically, this is the balance sheet at the end of June. And so what you've got here is 1.3 billion worth of assets, with some current assets as well. So, you know, it's 1.3 billion, as I said. And then a huge chunk, $1 billion here, and then 200 current liabilities. So 1.2 billion of debt or liabilities on 139 of assets. So you can see the gearing here is enormous, and that's how it's financing that big portfolio of mortgages, and that's how it's making returns. So it's geared up everything quite a lot. And that is kind of common to many of the other funds in that sector, that they are putting an awful lot of debt onto a very small base. So the two funds are going to merge. The plan is to complete that within 3 months. And they've got most of the UK mortgage investors on side already, so I think this is a done deal. Effectively, you're getting out of UK mortgages about 83p. So that's a lot higher than the M&G bids were, a lot higher than the share price was before the start of this process. It'd be a much bigger fund, obviously, overall. There's no cash exit, but there are economies of scale of knocking these two things together. Not least that the UK mortgages kind of overheads were relatively high, and they're supposed to be an awful lot lower in the structure. The underlying portfolio are going to have a sort of mark-to-market yield of about 7.2%, and from that they're going to pay a 6p dividend, so that's on about 5.6 dividend yield, which is quite attractive. And importantly, if there is anybody that doesn't like this idea, there is an opportunity to get out in, I think, September this year, to fourth quarter, but I think the details will be announced in September, alongside the kind of AGM thing. And then Throgmorton, This one I wanted to highlight it's been performing very well. You know that because we have written a note on it and explained exactly what was going on, and that was published in December. And if you are interested in this fund, I suggest you go and have a look at it. But just to reiterate, it's been outperforming its benchmark index, which is the UMIS Smaller Companies Index Plus AIM, by a big margin over the last year. And that's quite impressive in a period when obviously there was a bit of a value bounce and it's more of a growth type fund. But it just kept powering ahead. Because it was doing so well, it managed to issue stock, so 125 million quid's worth of shares issued, and that's obviously bringing down the overall costs for everybody. Pushed it into the 250 index, which helps with the rating. And I think impressively, despite the fact that markets were rising, it managed to make profit on the short positions that it held overall. That's actually, that sort of underscores the stock picking ability of the manager, I think. Here is though the short term, it's like 3-month share price NAV, and obviously things have come off recently, as you can see here. And the shares actually briefly went to a discount, well, not a huge discount at all, but a brief discount. Dan presented on the results this week, and actually he was quite adamant that this was completely unjustified. And there are good reasons for this. So, as we know, the main reasons why markets have been pulling back is because they think that interest rates are going to go up. And obviously, they've got that from people like Jerome Powell saying, refusing to rule out that there won't be 7 interest rate rises this year. And that's hit high growth stocks, because if you've got a stock where the cash flow is valued sort of going to come in the distant future, and you value it on a discounted cash flow basis, and higher interest rate, high discount rate means that your net present value is that much lower. So the NAVs come down. But as Dan says, the way that he goes about picking stocks, he buys companies that are profitable and cash generative now. He's not buying things that have got sort of hope value for the future. And he actually shorts things that are kind of speculative growth stocks where he doesn't think that growth is going to be achievable. And he also especially targets things where he thinks they might run out of cash. So he's actually positioned in the things that should be doing okay in this environment and positioned away from the things that should be doing badly. And he's also buys stocks that have got pricing power. And that's one of the sort of big things about his sort of quality threshold when he's looking for a stock. And that means in an inflationary environment, they've got the ability to pass on prices to their customers without losing business, or choose to undercut their competitors. And that's obviously helping, because he's saying that the portfolio companies are actually reporting quite strong trading, which is encouraging, I think. And I think that suggests really that maybe this pullback in the NAV might be a bit unjustified. I'm saying this now not because that pullback is particularly large. I mean, 40% is chunky, but in case we have another pullback on this again, I don't think that's going to be completely deserved. So there we go. That's enough